Hello, everyone. We got a few more minutes here, and then we'll jump into chapter 16. Again, as always, feel free to say hi in the chat. Again, as questions come up, you can always ask a question, and I'll do my best to answer it. And obviously, we're going to try to keep it as interactive as we can. Hey, Harry, how are you? Hi, Paul. Hey, Malachi. Hey, Samantha. Hey, Nate. Hey, Junwan. I hope I said that right. Oh, you go by Will. That's right, you go by Will. All right, well, we're a minute into it here, so I'm going to go ahead and get started. I know right now there's only, looks like there's only 8 people online. Thanks, Will. I did send out an email earlier this morning about study groups. I know we're about a week into it. I didn't want to be premature in sort of addressing any problems that the study groups might be having, namely, non-responsive group members. But this morning, hopefully, my email will prompt, hey Ryan, a little more activity. And so, especially those of you that are on this chat, feel free to reach out to your group members. If somebody is being non-responsive, just let me know. And this isn't meant to be a situation where they sign up for a group and then don't do anything. That's not the intention. And so, hopefully, that kind of prompts everyone to get involved and start creating something that's going to work and help everybody. Because I'm convinced thoroughly that studying together and working together is going to improve everybody's performance, and so I think it's worth the investment. All that to say, today we're talking about dilutive securities and earnings per share, and for most students, everything we've done up to this point is probably at least somewhat familiar. Hi Aiden. Hey Raphael. This chapter tends to be one where it's pretty new for most folks, and so I'll tend to move a little slower. There may be more questions. I totally get that, but this may be one that you need to review several times as well. So just be aware of that, and of course I'm completely aware of that. Hey Henry. All right, so let's kind of jump into this here. So. Basically, the idea here, there's two pieces to this. The number one, I'd say the one that most students probably think the most of is the idea of equity-based incentives for employees. And so, whether it's stock options or restricted stock, this is a very common form now of compensation within companies. And so, of course, we need to learn how to account for them. And so, obviously, sometimes this will involve issuing other securities like an option rather than issuing the shares themselves, and sometimes it actually is issuing shares. And so there's just a lot of these things we're going to talk about. I also recognize that we could spend 3 weeks on this type of topic depending on how deep we wanted to go, but we're going to kind of just, this is your first introduction to it, so we're going to cover a lot of different things, but probably not to the depth that we otherwise could if we wanted to. The other part of this is companies making this choice to finance through debt or equity. So that's kind of a major component. You kind of think about Chapter 14 and Chapter 13, we were talking about debt. In Chapter 15, we talked about equity. And so in this chapter, we're kind of bringing those two worlds together and saying, okay, companies have this choice to make. Do we issue debt or do we issue equity? And there are benefits and drawbacks to each. The big difference is that debt introduces financial risk. Now, risk is not good and it's not bad. It's just different. So risk kind of multiplies the returns or it multiplies the losses. And so financial risk is just what it says. It's just riskier, but it's not better or worse. But the more debt that a company takes on, the more financial risk that they have. The benefit to that, of course, that it increases returns on to equity for investors. In other words, if the company performs well, so I think a kind of a classic example is when somebody buys a house. So let's say that I could buy a house and put no money down, or let's just make it easy. $100,000 house, and I put 10% down. So I invest $10,000. Well, if that house appreciates 10%, then the house is going to be worth $110,000. And so from my $10,000 investment, basically I had a 90% leverage. I had 90% debt on this thing, and so it increases $10,000. Well, the interest that I might pay on $100,000 is going to be fairly negligible in a year. But if it goes up to 10%, I mean, I'm going to get an 80 or 90% return on my investment. So that's a pretty good deal. Whereas, let's say that I just paid cash. If I just paid cash, there's no interest, there's no debt, but I had to invest $100,000. If that same house goes up 10% in value, my return on investment is only 10%. And so it's sort of, the upside is pretty dramatic. Now, the downside, of course, is that if I invest $10,000 and finance the rest, and let's say that it goes down 10%, well, now I've essentially lost my entire investment, whereas I would only have lost 10% of my investment if I had invested the full $100,000. So it's again, as a return, it's a percent return, not dollar return. It's a percent return. Okay. There are securities that we're going to talk about that have elements of both. So they have elements of debt and elements of equity. We're going to talk about those in this chapter. All right, convertible debt. That's the number one. This is the number one, probably the most common type of security that has elements of debt and elements of equity. And so convertible debt, it provides the debt holder, like usually a bond holder, it gives them the option to convert their debt to equity at a future date. And so, again, the initial issuance is in the form of debt, but that debt holder has the option to turn that debt into equity. And so it does have elements of both. Under U.S. GAAP, there is no direct impact on income attributable to the conversion. So in other words, when that debt holder converts, or if that debt holder converts their debt to equity, under current U.S. GAAP rules, there's not going to be a gain, there's not going to be a loss. You're just going to take the debt off the books and bring the equity onto the books. So there's no gains or losses. Now, this is important. The conversion option may reduce the yield on the debt. So this is an indirect effect. In other words, there is value to having the conversion option. And so a lot of times the yield on that debt, in other words, the market's required rate of return, is going to be lower because of that conversion option. And so the company will have a lower interest expense as long as that debt is outstanding. So there is an indirect benefit to having the conversion option. There's just no direct income effect from the conversion itself. So there are three aspects of the conversion that we need to consider. First of all, we do have the issuance of the convertible debt. Under current U.S. GAAP rules, the entire issuance is allocated to the debt instrument. And so at issuance, the company acts as if it's just like any other debt instrument. So a bond payable, note payable, whatever it might be, without any attention paid to the fact that there's a conversion option. At conversion, U.S. GAAP requires what's called the book value method. And again, just to explain that means you take the debt off the books and you bring the equity on the books, and there's no gain or loss. And so you're just using the book value method. And then finally, if you have convertible debt that's outstanding and you retire, so if the company were to go out into the market and repurchase that debt or otherwise retire that debt, then you could have a gain or a loss, just like you did in Chapter 14. So that's really no different than anything we had talked about in Chapter 14. Okay, so let's talk about an example. So a firm issues $500,000 in 10-year annual bonds. The coupon rate is 5%. The bonds are issued at 102, which of course, hopefully by now we understand is a premium. The bond includes a conversion option where each $1,000 bond can be converted to 20 shares of stock. The bonds are issued on January 1st, 2020, and then 300 of the bonds are converted on December 31st, 2022, and then the remaining bonds are retired at 102 on December 31st, 2023. The firm uses straight line method to amortize the bond premium. So for this chapter, when we're amortizing bonds and things like that, we're just going to be using the straight line method just to kind of keep it simple. I don't want you to have to create, an effective interest amortization table or anything like that. Okay, so let's kind of walk through these journal entries. So the first journal entry hopefully looks very familiar. Since they're issued at 102, that means that the proceeds from the issuance were 102% of the par value, which would be $510,000. So the cash that the company is going to receive at issuance is $510,000. Of course, we allocate the par value to the bonds payable, and then the amount above par to the premium on bonds payable account. Again, I'm hoping from Chapter 14, this is a journal entry that you could do nearly in your sleep at this point in time. Okay, so now the second piece. So whenever we talk about these conversions, because some but not all of the bonds can be converted, you do have to think about each individual bond. And I think if you can keep each individual bond in mind, you have a very good chance to actually do the conversion correctly. And so if you kind of think about the premium per bond, it was issued at 102, which is basically means that the premium is 2% of the par value. And so since the par value for each bond is $1,000, that means that the premium per bond is $20. So there's a $20 per bond premium as part of this issuance. So then the annual amortization using the straight line method would be $2 per year, again, because these are 10-year bonds. So you take the $20 balance per bond, allocate it over the 10 years for $2 per year in annual amortization. So on December 31st, 2022, there's a conversion of those 300 bonds. So we're going to kind of keep this information in mind as we account for this conversion. So first of all, you have to take the converted bonds and any associated premium off of the books. And so in this case, the bonds payable entry, you have $1,000 per bond. That's the par value. And we apply that par value to the 300 bonds that are being converted, which means that the entry for the bonds payable account is going to be $300,000. And then for the remaining premium balance, so this is where you kind of have to think about what's going on. And so on December 31st, 2021, actually I could go all the way back to 2020. The company would have amortized $2 of the premium for each bond. They would have done the same thing in 2021, and they would have done the same thing in 2022. And so in other words, there would have been 3 years of amortization that would have occurred prior to this conversion. And so since there's at conversion, we're taking the premium off the books, the only part of the premium that we're concerned about is any remaining balance. And so there's $2 in the first year, there's $2 in the second year, there's $2 in the third year. And so this whole idea is that out of the total of 10 years, they would have amortized 3. And so the remaining balance, again, the initial balance was $20 per bond, and only 7/10 of that remains. The other way to think about it would be that, well, we amortize $2 over each year for 3 years, which means there would have been a total of $6 of amortization, and given an original balance of $20 per bond, the remaining balance would be $14 per bond. So at this point in time, at the time of the conversion, each bond has a $14 balance for its premium on bonds payable account. Does everyone kind of understand that? If you just give me like a yes or a, I don't know if we can do symbols in here, you can give me a thumbs up, whatever. Is everyone kind of following where that $14 per bond balance, where that comes from? Because that's usually, in this problem, the hardest part to understand. Good, Harry's got it. Aiden's got it. Thomas, good. And again, if you need me to re-explain it, just let me know. Ryan's there. It's good. Okay, good. Again, if you have any questions, just let me know. Okay, so you have that per bond balance. And so then, of course, we need to apply that So Raphael says, so it's 14 after year 3. Yes, exactly. And Nirmal Kumar wants me to re-explain. So let me kind of go back up. So just one more time. So the idea here is there is this ongoing amortization process. So we issued the bonds on January 1st, 2020. And so what we have to do is imagine in our minds, okay, what's been going on with this bond over the last 3 years? Because now we're at the end of 2022, which means we've had 2020, which is 1 year, 2021, which is 2 years, and 2022, which is 3 years. And so we would have recorded the interest payments every year for 3 years. As part of that process, we would have been amortizing the bond premium. Again, $2 per year. So if you kind of think about that, that's $2 in the first year, $2 in the second year, $2 in the third year, for a total of $6. And so the amortization of that premium would have been a total of $6. With an original balance of 20, you subtract the 6, which means there's a remaining balance of 14. The other way to think about it, which is the way I most commonly think about it, is to say, well, how many years remain in this bond's life? Well, we're at the end of year 3, which means there are 7 years left. And so since there are 7 years left on this 10-year bond, it means that 7/10 of the premium balance must continue to exist at the time of the conversion, which again, 7/10 of $20 per bond is 14. So again, that's kind of the two ways to think about it. And then we take that $14 per bond balance and we apply it to the 300 bonds that are being converted. And so the entry to the premium on bonds payable account is going to be $4,200. So again, we're taking the bonds and the associated premium off the books. So we need that premium balance off the books. No problem. Okay? And we also then have to, great. We also have to record the issuance of the common stock. So we're taking the bonds off the books, and now we're recording the fact that we're issuing stock. So we're going to issue, again, the conversion option means that every bond can be converted into 20 shares of common stock. And so that means there are 300 total bonds being converted. And so each bond can be converted into 20 shares. So 300 times 20 means that there are going to be 6,000 shares that are going to be issued as part of this conversion. So the common stock journal entry, you take those 6,000 shares, and of course we know for the common stock entry, we credit that account for the par value, and the par value of the common stock is $1 per share. So there's going to be a $6,000 entry to our common stock account. And then our APIC common stock account is just a plug that makes this all work. And so that APIC common stock journal entry, the idea here, again, this is the book value approach. It just serves as a plug. And so since it serves as a plug, there's no gain and there's no loss whenever these bonds are converted. All right, so then the journal entries. The first part of that is what we've already calculated, and that's taking the bonds payable off the books and the associated premium on bonds payable off the books. Again, that's from this calculation that we had just done, kind of in the middle of the screen there. And of course, then we're bringing the common stock. We're issuing the common stock, so we credit the common stock account for the par value, and then APIC common stock for any amount above par. So any questions on the journal entry for the conversion? Okay. So now we're going to retire the remaining 200 bonds. And so we kind of have to continue to go forward, right? So now we got to think, okay, another year has passed. And so there would have been another year of amortization, another year of interest payments, all those things would have happened. And so now we have to imagine where we are at this point in time when we retire those bonds. A couple of things, again, like if we kind of go all the way back, I don't want to go too crazy here, but there's a lot of information in this example. And so it says that on December 31st, 2023, so on that date, the remaining bonds are retired at 102. And so it's really important that we understand that there was a price that was paid, and that price was 102% of the par value. And so we're going to take that information and think about how to do this retirement. So first of all, again, we have to take the convertible bonds and any associated premium off the books. So again, with the bonds payable entry, the par value per bond is $1,000. We apply it to the remaining 200 bonds, which means the entry to the bonds payable account is going to be $200,000. Again, I'm hoping that part of it's not too difficult. With the premium on bonds payable, again, there's been one more year of amortization. So now instead of the 7/10 remaining, there's only 6/10 remaining. And so the balance in the premium is going to be 6/10 of the original $20 balance. Again, the other way to think about it is, well, we amortized $2 each year for 2020, 2021, 2022, and now 2023. So there would have been 4 years of amortization at $2 per year, means that total amortization of the premium would have been $8. And so given the original $20 balance, we subtract the $8 of amortization, which means the remaining balance as of the time of this retirement would have been $12 per bond. Again, I tend to think of it in terms of just the remaining balance, just the percent. That's just kind of how I think about it. But you can also just think mechanically through the amortization process, and you should be able to get to, I mean, you will get to the same answer no matter which sort of approach that you use. Again, I'm hoping this time through it's a little easier to understand where that $12 per bond balance came from. So for the entry, of course, we apply that $12 per bond balance to the 200 bonds that are being retired. We have to record the cash payment. And of course, for the cash entry, they are paying 102%. So again, the 200 bonds times the par value times the 102%, which is the cash payment that they made. That's the price that they paid. So they're going to pay $204,000. Now, because we are retiring these bonds prior to maturity, there could be a gain or a loss. And that gain or loss is just a plug in the journal entry. It's the difference between the amount of cash that we paid and the book value of the bonds that we're taking off of our books. And so again, we have the bonds payable, $200,000, the premium on bonds payable, $2,400. Again, that comes from the prior calculations that we just did. The cash payment is $204,000, and hopefully you see that we paid more than the book value of the bonds. And since we paid more than the book value, there is going to be a loss on bond retirement of $1,600. And we kind of just sit there for a second in case anybody has any questions. Okay. Looks like we're all right. All right, stock warrants. So Nate asks, can you slow down a little? Yes, Nate, I can slow down a little. I know it's sort of when I'm staring at a blank screen, it's kind of hard to see how fast y'all are writing and who's all keeping up and who's all not keeping up. Let me go back. I'm guessing you're trying to catch up on the journal entry. So Harry asked a good question. So since they were bought, or I would say issued, not bought, but I understand what you mean. Since they were issued and retired at the same price, why is there a loss? And the reason why is because of the amortization process. So if you kind of think about, I don't know, I wish I could draw this. Maybe I can. Let's see. Give me a second. Give me 1 second. Hopefully this will show you. All right, so let me see here. I'm going to try to do that as best I can. I'm trying to look at my, I don't know, maybe you can see that. All right, so if you're kind of looking at the graph here, so the initial issue price is 102, and then over time, the bond is being amortized, which means its carrying value is going down towards 100. So it's going from the premium at 102 down to the par value of 100. And so when this thing is retired, we're kind of out here somewhere. And so now the carrying value is somewhere below 102. And so if I'm going to pay more than the carrying value, there's going to be a loss. Again, I hope that makes sense. Maybe the graph helped a little bit there. I don't know if it did or didn't. So when you convert in the COT, you wouldn't have a gain or loss, but you settle the bonds for cash, a loss or gain results. Yes, if you retire it before maturity, because if you all wait all the way to maturity, you just end up paying the par value out, and the carrying value of the bond is par as well. So the only time you're going to have a gain or loss is if you retire the bond prior to maturity. And Harry, did that graph help you? Good. Yeah, normally in class I draw that graph. I didn't think to draw that graph here. Normally in class I kind of draw that out there to show that the 102 ends up being a loss. Okay. Stock warrants. So a stock warrant is a right to purchase stock at a future date at a predetermined price. So it's a right. And so people will pay money to have these rights. And so again, the hope is that the price will go up and then you'll have a discount. Basically, that's the idea. But unlike a conversion, with a stock warrant, you actually don't forfeit the security. So if you think about that convertible bond, the holder gave up their bond in order to receive the shares, but they didn't have to pay any cash. With the stock warrant, you actually don't give up any security. Instead, you just pay cash to exercise the option. And so again, what they're hoping is that that predetermined price is less than the market price. And so what you do, let's say that I have a right to buy Microsoft stock at $20 per share. And let's say I pay $5 for that right. All right. Well, what I'm hoping is I pay that $5, and then at some point in time, Microsoft stock is trading at an amount $25 or more. Wouldn't it be great if the stock price went to 30 or 40 or 50? And then what I can do is I can say, well, I'm exercising my right, and I'm turning in my option, and I now get to pay you, Microsoft, I get to pay you $20 per share. So I pay Microsoft $20 per share, and then what am I going to do? I'm going to turn right around and I'm going to sell that share in the market, maybe for $30 or $40 or $50, whatever the market price is at that time. And so that option can end up being very valuable. The downside, of course, is that let's say that I have the option to buy the shares at 20, and let's say that they're trading at 15. Well, that option is completely useless now. So I've paid $5 in this example that I'm kind of talking about. I've paid $5 and it ended up being completely worthless. And so that's kind of the downside of these stock warrants, is you may pay for that right and then end up not being able to exercise it. So there are two types of stock warrants. A detachable stock warrant basically means that the two can be independently traded. What that means is, imagine I have a security, usually a bond, and I have a stock warrant, and they're issued together. Well, a detachable stock warrant means after they're issued, they can be broken apart, which means that the person with the bond can do whatever they want with that bond, and the person with the stock warrant can do whatever they want with the stock warrant. They do not have to go anywhere together. They trade completely separately after the issuance. And so that's a detachable stock warrant, where the two can be detached from each other. Versus a non-detachable, of course, means wherever one goes, the other one goes. And actually, a non-detachable stock warrant is very similar. The accounting is very similar to a convertible bond, actually. So that's a little bit different. We're focused here on detachable stock warrants because we want to kind of understand, when they detach, how do I handle that stock warrant piece? The bond piece we covered in Chapter 14. That hasn't changed. Now we're talking about, well, what do I do with that stock warrant? And that's really what the point of this section is. There are two methods that we can use. So when we have detachable stock warrants, we have to do what's called bifurcation. And so bifurcation means that whatever issuance, whatever I receive from the issuance, I have to allocate some of it to the stock warrant. I have to allocate some of it to the bond or the underlying security. So the word is bifurcate. I have to bifurcate the issuance. And so when it's detachable. If it's non-detachable, then I don't have to do that. I just allocate everything to the bond. And so there are two methods that we can use to bifurcate, in other words, to allocate to the stock warrant and the bonds. One is called the proportional method, and the other one is called the incremental method. And so the proportional method is used if the firm can reliably estimate the fair value of both the bond and the stock warrant. So in other words, if I can reliably estimate the fair value of both, then I need to use the proportional method. If, on the other hand, I can only reliably estimate one of the items, then I use the incremental method. All right, so if I can reliably estimate both, I need to use the proportional method. If I can reliably estimate only one, then I use what's called the incremental method. And again, most of this should be in your notes.